You're sitting on the couch. It's 11:42 p.m. The room is dark, lit only by the cold blue glow of your phone. You just got paid, or maybe a bonus hit, or maybe you finally sold that old gaming console. You feel that specific little rush in your chest, that dopamine hit that says, okay, I'm not going to be broke forever. You open your brokerage app. You see that nice, round number sitting in your cash account. It's not $1 million, but it's yours. It's potential. So you do what every YouTube guru, every TikTok finfluencer, and your anxious coworker Dave told you to do. You buy. You buy the dip. You buy the hot ETF. You buy the crypto that's supposedly going to the moon next week. You hit confirm and you feel like a genius. You picture the compound interest curves arching toward the sky. You picture yourself on a yacht, or at least not panicking when the car makes a weird noise. But here's the catch. 2 weeks later, your transmission blows. Or your landlord raises the rent by $300. Or you lose your job. And because you dumped all that money into the market, which is basically a casino that you're not allowed to leave for a few years without paying a penalty, you are screwed. You have to sell. And guess what? You're selling at the exact moment the market is down because you don't have a choice. You just turned a smart investment into a guaranteed loss. You played the game, but you played the rounds in the wrong order. You tried to build the penthouse before you poured the foundation, and the first storm that came along, it washed the whole thing away. Let's talk about why this happens, because it's not your fault. Well, it is your fault, but the system is designed to trick you into making this mistake. The financial industry is a $1 trillion machine built on one simple premise, convincing you that investing is the same as getting rich. It's not. Investing is just a tool. A hammer is a tool, but if you try to eat soup with a hammer, you're going to have a bad time. That is what most of you are doing with your investment accounts. The trap is the order of operations. Think about building a house. If you hire a contractor and they show up on day one with a truckload of roof shingles and expensive chandeliers, but no lumber, no concrete, and no blueprint, you'd fire them immediately. But when it comes to money, you see a shiny stock tip or a hot new asset class, and you start nailing shingles to the dirt. You're prioritizing growth over stability. Here is the statistic that keeps me up at night. According to the Federal Reserve, nearly 40% of Americans would struggle to cover a $400 emergency using cash or equivalents. 40%. Yet the conversation online isn't about how do you get $400. It's about how do you turn $50 into $50,000 using options. It's absurd. We have people who are one flat tire away from disaster, trying to time the market on Tesla calls. It's like trying to run a marathon on a broken leg. You're not broken because you're not rich yet. You're just following a map that leads off a cliff. The system is tuned so that most people never wander too far from consumer and into owner, because consumers pay fees and owners collect assets. My name is Jojo. I'm obsessed with how money actually works in the real world, not the fantasy land sold to you by people wearing rented Lamborghinis. I break down the scams, the traps, and the boring math that actually builds wealth. Disclaimer time. This is education and entertainment only. It is not financial advice. I am not a financial advisor. I am just a guy on the internet who shouts about charts. Consult a professional before you make big money moves. Don't sue me. Now let's fix the order. We need to talk about phase 1 versus phase 2. Phase 1 is the grind. It's the years where you are stabilizing your life. This is the ugly part. This is the part where you are trying to get out of debt, build an emergency fund, and stop living paycheck to paycheck. This is also the phase where the system tries to tempt you the most. When you are in phase 1, you are desperate. You want to win. You want to feel like you're moving forward. The banks and apps know this. They send you notifications. The market is up. Invest your spare change. They make it feel like you're missing out if you don't throw your last $100 into Apple stock. This is a trap. When you are in phase 1, your number one investment is asterisk, and your number one asset is liquidity. Having cash is not lazy. Cash is a shield. When you have no shield, you cannot walk onto the battlefield. Psychologically, this is the hardest part because it feels boring. Putting $500 into a high-yield savings account feels like nothing. It doesn't move. It doesn't flash green and red. It just sits there mocking you, but that boredom is safety. If you lose your job, Apple stock doesn't care. Your landlord doesn't accept shares of AMC as rent. Only cash pays for survival. Phase 2 is the growth. This is when your foundation is set. You have no bad debt. You have 3 to 6 months of expenses sitting in cash. You are no longer one emergency away from bankruptcy. Now we start investing. Now we can afford to take risks because we don't have to sell the second things get scary. The difference between Phase 1 and Phase 2 investing is that in Phase 2, time is on your side. In Phase 1, time is your enemy because you need the money yesterday. The system pushes Phase 2 strategies on Phase 1 people because that's how they make money on fees. If you buy and sell constantly because you're panicked, they make money. If you buy and hold for 20 years, they make very little. They want you active, anxious, and confused. Let's look at the boring math that proves this. Let's say you have $5,000. You also have $5,000 in credit card debt at 22% interest. Option A. You invest the $5,000 in the stock market. Historically, the S&P 500 returns about 10% a year on average. In a great year, you make $500. Meanwhile, your credit card debt is costing you $1,100 a year in interest. Net result? You are down $600. You tried to swim upstream. Option B. You pay off the debt. You get a guaranteed 22% return on your money. There is no stock in the history of the world that can guarantee you a 22% return with zero risk. Paying off high-interest debt is the single best investment you can make, period. Then there's the issue of the forced sale. Let's say you ignore the debt and invest that $5,000. The market drops 20% in 6 months, which happens all the time. Your $5,000 is now $4,000, and then because you didn't have an emergency fund, your car breaks down and needs a $2,000 repair. You have to sell your stocks at the bottom to pay the mechanic. You locked in that loss. You turned a temporary paper dip into a permanent hole in your pocket. Vanguard and other firms study this thing called the investor gap. It's the difference between what the market returns and what the average investor actually makes. Why is there a gap? Because people buy when they feel good, high prices, and sell when they are scared, low prices. They have to sell because they never fix the foundation. The math punishes panic. Let's look at 2 people to make this real. Meet Alex and Jordan. Alex is in a hurry. He makes $50,000 a year. He gets a $3,000 bonus. He wants to feel rich. He hears about this new EV company that's going to change the world. He puts the whole $3,000 into the stock. He doesn't have an emergency fund because he thinks my investments are my emergency fund. 3 months later, the market corrects. His stock drops 40%. It's worth $1,800. Simultaneously, his appendix bursts. He has a $2,500 deductible. He has to sell the stock at the bottom. He loses the money, he goes into medical debt, and he's now more stressed than before. He blames the market. He says, investing is a scam. Jordan makes the same money, gets the same bonus. He's bored. He puts $2,000 into a high-yield savings account for his emergency fund. He puts $1,000 toward his car loan. He has 0 investments. He feels like he's missing out, watching the tech stocks soar. 2 months later, his appendix bursts. He writes a check for $2,500 from his savings account. He doesn't touch his debt payments. He doesn't panic. He heals up, goes back to work, and slowly refills his savings account. He is now stable. He has a floor. 6 months later, the market crashes. Jordan, who now has a refilled emergency fund and no high-interest debt, sees a sale. He buys the stocks that Alex just sold in a panic. Jordan buys low. Alex sold low. One played the game in the right order. The other played in the wrong order. Same event, totally different outcomes. So, what is the playbook? How do you fix this if you realize you've been doing it backwards? 1. Build the floor first. Before you buy a single share of stock, you need 1 month of expenses in cash. Just 1. Stop calling it an emergency fund. Call it your sleep at night money. This prevents you from selling investments when life happens. 2. Kill the leeches. List your debts from highest interest rate to lowest. Attack the highest one with every extra dollar you have. Credit cards, payday loans, personal loans. If the interest rate is above 7 to 8%, treat it like a house fire. Put it out. You cannot build wealth on a foundation of high-interest debt. The math will crush you every time. 3. Take the free money. If you have a 401k at work and your employer matches contributions, that is the one exception. Contribute enough to get the match. That is an instant 100% return. Do not leave that on the table. 4. Finish the foundation. Build your cash reserves up to 3 to 6 months of expenses. This is your bunker. When the world goes crazy, you go in here and lock the door. 5. Then and only then invest. Once the debt is gone, except maybe a low-rate mortgage, and the bunker is full, you open the brokerage account. Then you buy the index funds. Then you buy the stocks. And because you don't need that money to survive, you can hold it forever. You can let the compound interest actually work instead of panicking every time the news says a scary word. Here's the mindset shift you need. Investing is not the starting line. It's not step 1. Step 1 is security. Step 1 is not being at the mercy of your boss, your landlord, or your transmission. The system wants you to skip the security because they make money when you are desperate and trading. The real catch is that the most boring part of personal finance, saving cash and paying bills, is actually the most profitable investment you can make early on. Stop trying to hit a home run when you're still struggling to find the batter's box. Protect your first $10,000 like it's the floor of your life, not the finish line. Once the floor is solid, then and only then do you start building the penthouse. And hey, bring a helmet. It's a wild world out there.